Welcome to Pathway to Property, your go-to podcast for building a property portfolio and breaking down property markets.
Hello, everyone, and welcome back to the next episode of Pathway to Property. I'm one of your co-hosts, Lachlan Vidler. I'm joined, as always, by my good friend, Luke Clifford. Lukey, how are you, mate?
I'm doing very well, mate. I was holding down the fort in the Atlas office last week. You're away recording. I'll let you speak about that a little bit more. I know how excited you are to share that with everybody. But been pretty well, man. The weather in Sydney has been pretty doom and gloom lately, so I haven't been really getting out and about. But going all right. How have you been? Oh,
mate, not bad. Obviously, out of office last week, filming another episode for the Channel 9 show that I've joined as their investment expert, Budget Battlers. So it was another good week of filming. I won't say where we were in Australia, but it was great. Another house renovated. Another very, very happy person who they were just beside themselves when they saw the results of it, which was so nice and wholesome to see because they more than deserved it. But it's always hard being out of the office. I feel like it's almost like
Is it hard though,
not
mate?
that I have kids, but it feels like what I imagine it feels like to leave your kids, right? I leave you and everyone else in the office, but
the place hasn't fallen apart yet, mate.
Not yet. But mate, we got an awesome episode, and
we have a huge episode for our listeners. Bit of a treat.
We do.
We've got a
first episode.
First
episode with a guest, right? I don't know how many we're in now. I mean, we must be 10 or 11 in, and we didn't know when we were going to kind of introduce somebody other than ourselves. But I'm very happy to say that I have a very good friend, a very good mentor, somebody that I've known for a number of years now, and have been very instrumental in my journey. And in the studio today, we're joined by Jeremy Iannuzzelli. Most people will know him around Australia as one of the foremost experts in accounting, but particularly on the property investment side and helping investors to build their portfolio. So, Jeremy, thank you for joining us, mate. How are you?
Lachlan and Luke, it's been number one, thank you very much, and it's a pleasure to join you both today. But it's pretty much a full circle moment. I remember meeting Lachlan, we're going now nearly 8-9 years ago, when you were investing in property and you were very focused, very driven. You knew exactly what you wanted to do, how you're going to get there. And my role was just kind of making sure that I pulled the reins back a little bit, that you weren't going to, overload yourself with too much debt. And, thankful, to be considered a mentor, but a bit of full circle now where you're going to be asking me the questions, I suppose, and interrogating me as I interrogated you to make sure that you were on your path. But it's been exciting to see, Atlas and what you guys stand for and the growth that you've seen over the last number of years. And it's exciting to see you on the board of Pippa, and I think that's chairman as well.
Yeah,
by
just
memory.
taken over. Yep,
chairman, and that's exciting because I know that you're a person that holds a lot of high morals and ethics. And you take that into your day-to-day life, not just yourself personally, but your business as well. So it's exciting to have this chat with you guys. Yeah. I'm excited to get into my love, my passion, which is property, but also tax and structuring, and really bust the myths, I should say, bust the myths around some of the things that you should and should not. Yep. And just have a very inquisitive but also an interrogating mind to ensure that what you're doing is actually going to help you and not take you back.
Yeah, I love that. And you're right. I didn't actually think of that before coming in, but you're right. It is a full circle moment. And I think for me, something I really love about this moment, though, is that the journey I've had since we first met years and years and years ago, and all the help and guidance you gave me over that period, and then obviously to the position I'm in now. But you've also grown so much over that period. You are absolutely respected amongst the industry for your expertise, and I think it's fantastic that we can both sit here, and obviously joined by Luke as well, and be able to share.
Yeah, don't let me get in the middle. Don't let me get in the middle of the bromance.
This is definitely a bit of a bromance moment. Just looking back, and
that's why we had to put ourselves across the table, so we had a bit of gap between us.
It's been a long 8-year journey. It has, and just as a reflection, it's been fantastic.
Yeah,
it's good to see where you guys both are, and I listen to the podcast, and there's a lot of gold nuggets you guys give. And there's a lot of, I wouldn't call it advice. I'd never use the word advice, but a lot of stories, war stories, and they're important. They're the things people need to listen to when you're growing. And growing the right way, of course, as well.
Yeah. Well, why don't we go and try and add some more nuggets into our film roll, our camera roll, and the audio records of the Pathway to Property podcast. We have an exceptional episode today, right? I mean, we've already talked about what you do, which is, for anyone who doesn't know, you are an accountant by trade with deep technical expertise in the property and property investment development side as well. And today, what I want to do, and I have to actually say, this was Luke's idea. It might be a full circle moment, but I got to give Luke the credit here. When we were sitting and thinking about what we wanted to do for our next episode, and for everyone who's been listening along for the journey, we've been taking this season, an episode every month about taking people from the very start of their journey, starting with how they need to think and what they need to think about through the whole process of market analysis, property analysis, due diligence, planning, teams, and so many other things. The whole point of this season has been to give someone the tools to start their journey all the way through to the end. And structuring is one of the most important things. And Luke had the brilliant idea of bringing on a guest. I had the brilliant idea of the guest being you. But Luke put the idea out here, and I could not agree with him more. We obviously aren't qualified to give that advice, but it is such an important discussion that I thought we couldn't not do that under the guise, with the guise of what this podcast, at least the first season, has been all about. We couldn't not touch this topic. So I've said a lot of words just then, but what I'm really getting at is we have an awesome discussion about structuring coming up. So much gets said about it. So much gets said about it in the industry. There are so many things that aren't understood. And having somebody to come in and join us, everyone who's listening along, I'm not sure what minute we're up to of the podcast so far, but every minute after this one is going to be packed with so much value coming from Jeremy.
Absolutely. And one of the big reasons why I also wanted to kind of put this kind of episode together is like the conversations that we have with investors. It's like a lot of people come to us wanting to build out scalable property portfolios. And a lot of the time, like these are people that are just starting out on the journey, or they might have only 1 or 2 investment properties under their belt, where they've spoken to their broker has just got them pre-approved, and they're just like, let's go shopping, without any kind of real foresight on the next 3, 4, 5 steps ahead. And then down the road, when they get stuck, they then wonder why. So I thought it's really, really important for our listeners to kind of listen in with someone with, Jeremy's kind of knowledge and expertise in this space to provide. Obviously, we're not going to provide any kind of financial advice on this podcast episode, but it's just going to help people think about things a little bit differently.
Yeah, I suppose the devil's always in the details, and it's getting people to invoke those thoughts, those conversations with the professionals around them. One of the biggest things I see is people try to use the professionals more as a transaction as opposed to a journeyman. And I've always said you really need to bring your professionals along for that whole journey with you. And it starts with the lending strategy. As you're buying property 1, they're thinking about property 3 or property 4. But lending strategy really is the first starting point, which then leads to the acquisition strategy.
Yeah.
I think if you guys as a buyer's agent, property advocates and property specialists can see a very clear path, a very clear lending strategy that a broker's put together, you guys can then create the acquisition strategy behind it. Then my role as the accountant, I'm actually quite easy. I interpret both the hard work.
We're talking about property though. I didn't ask if you're easy.
Once we've got those two, once I see those two things in place, I can see a really clear lending strategy based upon what the client's needs are. You guys have a really clear acquisition strategy to help get them there. I'm putting together a structure to match it.
Yeah.
You guys are doing all the hard work. I just get to use the right structure to match those two things and ensure that as an accountant, we're providing inhibitors to help people grow as opposed to prohibitors, which could be structuring where it comes to key. And yeah, can't wait to talk about that in more detail.
Yeah. Well, I think I love what you said there, because you're absolutely right. It does all start with the lending side, right? And that's not to say don't come and talk to us first. That's a very important point. But that's why, for example, when we build out portfolio plans, the first thing that we say to clients once they sign on to work with us, we're going to go build out their portfolio plans, we need to understand your borrowing and lending circumstance right now, because we can sit here and we can plan out 10 acquisitions for you this year. But if it's not practical, it's not going to work. And not just that, if it's not going to be practical about where you might look to be in 2, 3, 5, 10 years, that also isn't going to match that journey that you want to undertake. So I completely agree with you. I think lending is such a key part, and you need to understand that journey. And that's where if you don't have a good mortgage broker or person in that realm, that's where reaching out to somebody like us can be helpful, because we can put you in place, right? Or reaching out to somebody like yourself, Jeremy. But let's dive into it today. Let's start really simply. Talk as long as you want on this, right? But I think let's just break it down for anyone who isn't sure, and even people who are sure. Maybe there's a bit of a nugget they can take away from this. Could you just give us a bit of an explanation about what structuring actually means when we're talking about property and property investing?
Yeah, so structuring is the way we own an investment, the title owner, and it's a good way. I think the podcast name's fantastic because it's a pathway to property. Ownership, is that initial point. So, your common structures of owning a property would include individual ownership.
Yeah.
That's your own name going on a title, whether it's your name, your spouse's name, together via joint tenants or tenants in common, very specific. There's a difference.
Yeah.
So you need to consult with your solicitor about that. But nevertheless, that's the most easiest, simplest form of structuring a property with your own name. Then you start to be a little bit more sophisticated as you go through your journey, and you start to look at corporate entities. And that could include things like trusts with individual or corporate trustees, and there's a big difference between both. And from a lending perspective, asset protection perspective, there's a big difference of who the trustee is, whether it's that $1 company or it's individual trustee. Then you start to look at companies. If you're a company owner, you're running a business and you've got lots of retained earnings and you want to try to have as much capital going towards property as you can, you may want to look at buying in a company. And then you've got one of your last structures that a lot of people are doing, in fact happening right now, more so than ever, is establishments of self-managed super funds.
Yes.
A lot of people have seen some good growth in their super post-COVID. They're getting their 200, 250, 300 grand. They're starting to see things idle off a little bit, plateau, and they're starting to see the property market become a little bit more buoyant as we talk about interest rates coming down. And they're looking at establishing self-managed super to be able to do that. So 4 common ways to structure property purchases, starting from your simple way, your individual ownership, moving to more sophisticated manners, your trusts with corporate trustees or individual, depending on circumstances, companies, and self-managed super funds. My rule of thumb, and I always talk about my rule of thumb because there's no textbook about it, your first 1 or 2 properties that you want to buy, you want to do that individually. You want to keep it cost effective. You want to keep it simple. There are rare circumstances as to why you would go into structure earlier, but nevertheless, you want to keep it low cost. You want to have as much of your capital going towards your first 1 or 2 purchases as you can. There are things like land tax to consider on a state-by-state basis. For argument's sake, here in New South Wales, we have a capped land tax threshold of $1,070,000. Now, I say capped because that's got through without any media attention. And I was, sharing this with you and how disgusted I am and how it got through with little media attention. But New South Wales has been one of those states that have been indexing their land tax threshold for a number of years, and now it's just been capped at about a ticker, about $1,070,000 as a threshold. So now no longer will it continue to grow, and it's going to be capped along with the other states. But you want to factor that in if you're buying here in New South Wales, or other states around the country have a land tax threshold, sometimes slightly better for individual ownership. And then once you start to get past those 1 or 2 properties, again, lending strategy in play, it depends on your income, where you are in your employment journey or business journey, that's when you want to start to look at structure. Because if you don't look at structure and you can't see your income indefinitely increasing, exponentially above inflation for the rest of your working career, then there will be a time where you stop investing and you get capped out. And there'll be very little movement forwards for you to continue your buying journey. So moving into structure, Luke and Lachlan is imperative, but I always tell clients it needs to be the right time.
Yeah.
And I think if you're not doing that, you're spending money unnecessarily on cost of compliance and cost of establishment.
Let's just break it down for everybody who's listening in, right? You mentioned, and you took the thunder away from me, let's say that. You mentioned a bunch of different ways that you can structure, right? And I'll rattle them off the way that I think about it. Feel free to add in if you want to. But for me, I think there's probably 4 really key ones that jump to mind about how somebody might structure. And what I'd love is I'll list them out, and then let's go through one by one, and maybe you can talk about some of the pros and the cons, I guess just a little bit generally about each one. And then I think after that, I don't know if this is a bit of a stitch up or not, but I think Lukey might have a couple of examples that he might want to run past and get your ideas on what might be the best in that circumstance,
Absolutely. Right? Someone's definitely going to be getting some free advice. So if that's your example, enjoy it.
All right. So the 4 that I think about are, first, you got your personal name, right? Second is you're looking at a corporate entity like a company, right? Third, you've got something like, say, a self-managed super fund. And fourth, it's not a pure play fourth. It's kind of a bit of a hybrid of all of them, but something we're hearing a lot about, and we've kind of already touched on already, looking at a setup of sort of a trust and then a corporate trustee over the top of that. They're the big 4 I think of. Are there any others that you'd add on top?
Yeah, look, you've got hybrid structures where people kind of come together to invest in, together, like a unit trust for argument's sake. Great way for people to have a defined level of ownership in a separate legal entity. So really good asset protection purposes, but not common.
Yeah.
You'll see that for people that are well into their journey and they're, starting to look at ways that they can grow in different manners, where it could be in development as well. But yeah, they're the main 4. If you're looking at buying a property and you're building a portfolio for yourself, they're the main 4 entities that you're looking at.
Yeah, awesome. Okay, well then let's start off. I don't know if you call it the easiest one. It's probably the most common one, right? Is investing in your personal name. So, for example, you mentioned that there are different versions of that as well, whether you're tenants in common or
joint tenants.
Exactly right. So let's jump in with that one, right? If you could maybe take us through biggest considerations with that, some of the pros and cons, and sort of how somebody might find themselves in that scenario.
Yeah, beautiful. So ideally, and again, misconception out there is, might be partnered, husband and wife, or partner, whatever it may be. You both can go on the loan as co-guarantors, very common, and one person can own the property. And I'm a big fan of that because, most people have very different taxable incomes and therefore very different tax rates. So there is strategy even with the most simplest way of owning properties. It might be a wife that's earning $200,000 a year, paying tax at 47 cents. And husband might be, flip the coin, and might be stay at home, earning very little income. Well, we ideally want to be buying the property in the spouse's, the wife's name, where if it's negatively geared, there's a substantial amount of tax benefit coming back at 47%. Now, I'm one of the rare professionals that can guarantee people a certain amount of money as a return. And that comes back through the tax system. So if you've got, say, again, 2 different people at 2 different tax rates, if we're buying a property in person who's paying tax at 30%, negatively geared, person who's paying tax at 40%, property's negatively geared, well, that's a 17% return additional on the negative gearing that someone's paying on holding that property. And again, it can come through means of losing cash or depreciation. So clawing it back, individual ownership, low cost, 50% discount applied. So holding a property for longer than 12 months, you're eligible to only pay tax on 50% of the profits. If you do sell it within 12 months, you will be paying tax on 100% of the profits at your marginal tax rate. So that's something to take note of. Losses that are incurred on the property through means of losing cash or non-cash deductions such as depreciation, i.e. as we know it, called negative gearing, we do get a refund back. We have eligibility for PYG variations, which means that rather than getting a big lump sum of refund back at the end of the year, we can get that back little bit by little bit throughout the year as a reduction of the tax our employer withholds. So they're the main things around buying individual names. Main benefit being tax. For most cases, majority of people starting off their property journey will probably have negative geared investments, especially at today's rates. If you're putting down 11, 12, 13% deposits, property's going to be negative. Not to say that's a bad property. I've bought many properties that are negatively geared, and there's been a far substantial amount of capital growth that outweighed the cost that I held. Taking into account the tax benefit I received as a cash benefit, laughing. It was paying a little bit of cost today to get back a significant return in the future. So that's your first one.
Yeah.
Easy, simple, low cost, effective.
Yeah.
But not necessarily great for scaling large portfolios.
Yeah. And just to jump in there as well, like with the whole PAYG tax variation, this is something that also gets brought up in a lot of the conversations that we have with people, because when you're kind of running through cash flow projections, a lot of the time people are looking at what that before tax cash flow position is going to look like. But with something like a PAYG tax variation, because they're getting that that tax rebate or tax refund kind of distributed into their pay almost, they can have a look at that after tax figure as well.
Absolutely. And I always, with all my clients, I'm always really discussing the nature of the property with after tax calculations being taken into consideration.
Yeah.
Because after tax calculation is your true position of loss or profit.
Yeah.
And I've seen properties, believe it or not, that have a after tax calculation showing a positive position, even though the property is negatively geared. And that can come from things like, renovations where it's been depreciated, depreciation for essentially on new homes, borrowing costs, things like LMI coming into consideration, capitalised normally into the loan, and you get a tax benefit amortised over 5 years. So after tax calculation is truly important. It's going to give you the real position of your portfolio, and that's going to give you the ability to hold properties longer and more healthier as well.
I got a statement and a question for you. Statement is, I love what you were saying around the negative gearing, but I love it because I also know a phrase that you've said to me a million times over, and I want to get it on the record in this one, which is that negative gearing is an outcome, not a strategy.
Absolutely.
Right? And you've said that to me that many times I've lost count, and I've now hijacked it. I say it wasn't my saying, but I'll certainly hijacked it for my conversations. But I like that you brought up what you did around the fact you've bought properties, because I think that the way that I see it, there are two big misconceptions that get around, right? The first one is that people look at it as a strategy, right? Which is, I want to buy a negatively geared property, which obviously I think we could all agree is a silly statement to make without any consideration about the property itself, just to say, I want this for this reason. But then on the flip side, again, something that you mentioned is right now, most properties are probably negatively geared. Most in the way that we think of vanilla property, a vanilla house, established property that you're buying, because of where rates are at. And right now, it doesn't mean it's a bad property. It's just a function of what the expenses are in this current environment. But if rates were a little bit different, and as they are coming down right now to probably a bit more of a normalized, probably a 4% is the way that I see it. I think over the next 18 months we'll get down towards that 4% range, probably pretty high 4, but not, but still quite good. Now we start to return those properties to a neutral state.
Absolutely.
Or getting very close to a neutral state, right? So
absolutely. When I first started investing a long time ago, my interest rate was nearly 8%.
Yeah.
And that was normal.
Yeah.
And then post GFC interest rates started to come down. And I remember I high-fived my old man when I started to have an interest rate of 7%. Fast forward those initial properties 20 years.
Little did you know where it was going to go.
They were getting 2% rates, and it was just ridiculous, money for jam. But what I have seen of those properties is one thing I always tell people, you are borrowing with today's dollar and paying it off with tomorrow's profit. And that's one of the biggest things that people need to understand. And that's my lessons and my learnings of understanding the way economies work and currencies work, is that debt does inflate away.
Yeah.
And people don't understand, and I get really passionate about it. The RBA or federal banks around the world are telling you that we're going to inflate the economy and your dollar's going to be worth less by 3-4% every year. Now, that means on average anywhere between 17 to 19.66 years, everything should double. Now, we know things have been doubling much faster than that. Real inflation is not what we see out there, which is 2 to 3%.
Yeah.
That's actually been told, that's in your face. It's actually been portrayed on every single mode of media out there.
Yeah.
But people still don't seem to recognize what's right in front of them, written in the big, boldest letters. The economy will increase or double at least once every 16 to 20 years.
Yeah.
That's from what the target of the Reserve Bank is.
Yeah.
So for people to think, that I'm going to borrow money and it's going to be huge. No, guys, you need to understand that probably conservatively 16 to 20 years, you borrow 200 grand, it's going to be like worth borrowing 100 grand.
Yeah, exactly right.
So that's something that people need to understand, and that's why getting into assets, especially as things change, is very important.
All right, mate. I love that. I did say I had a statement and I had a question. So here's the question time, all right? And I know you were just giving an example before when we started talking about the personal name, but you mentioned the fact that you can have two people go on a loan, but only one person go on the title, for example. And then you gave that example around a wife who earns $200,000, and then the husband who's actually a stay-at-home. And I don't know if it was actually linked into that, but I thought I'd just come back to it. Are you saying in that sort of a circumstance, it might make sense for the husband to be on the loan but not on the title?
Yeah, well, absolutely.
Why, if that's the case?
Yeah, absolutely. And again, I used a very exaggerated example, but let's say the husband's earning 40 grand a year part-time. That extra 40 grand that he brings in on top of the wife's $200,000 is going to improve the borrowing capacity.
Definitely.
Because they're co-guarantors, their spousal benefit.
Yeah.
Again, family laws are very different. beast, and it beats kind of to the tune of its own drum. So they don't care. They lift the corporate valve. They don't care how things are owned. They care about the assets being produced with inside the relationship, how it's all worked out, and they kind of split it based upon a magistrate at that time. But yeah, improves borrowing capacity, significant amount of tax benefit for the higher income earner, again on the basis that the property's negatively geared. Flipped if the property's positive.
Yeah.
Could be buying a really good positive property, and at 40%, they're paying tax at roughly 16, 17 cents in the dollar with the new tax rates. Why am I going to be buying half that property or 100% of that property in the wife's name, losing 47% tax on the profit it makes? So structuring, when we talk about individual ownership, while it's not a form of a company or a trust or a super fund, it is still a structure to own.
Yeah.
And there is some substantial benefits cash flow wise that comes as a result, which could materially change the way your portfolio performs.
Yeah, no, I love it. I thought that'd be your answer. I kind of wanted to lead you down there because that extra income, I don't think people realize how valuable $30,000, $40,000, $50,000 can be on top of a primary income earner, right? Or sorry, not them having it, but coming from a second person in that, because when they're getting assessed on their borrowing, their living expenses are being assessed as a couple with children or whatever the circumstance might be. So, yeah, for everybody listening, do not forget the power of an additional income in the household, right? If you're a stay-at-home parent, don't forget that if you picked up 2 or 3 days of work and made, a $80,000 annualized figure, but it gets brought down to a 2 to 3 day part-time rate, that is so much more powerful than people realize. So that's the first call out. There you go. That's the first call out. All right, let's move on to the second one. So let's talk about a company, a corporate entity, typically a company, just sort of vanilla in that sense. Not the trustee stuff yet, but just a regular old company.
Becoming more common now.
Yeah.
Becoming more common now. So typically what I'll see when people invest in a company is companies don't receive a 50% discount, regardless you hold it for 2 months, 6 months, 12 months, 10 years.
On the capital gains.
On the capital gains.
Yeah.
So you make $100,000, you pay tax at the company tax rate. Now, there's an active and passive test. Essentially, businesses under a certain amount of income that are actually providing services, they have an active test being met, which means they pay tax at 25%. If you've got a company which is just an investment entity receiving income from passive investments, like property rent and all those other things, then the tax rate will be 30%. Now, what a lot of people like companies for is they might have quite a bit of retained earnings in their active entity. They might be running an accounting firm, doing very well. They make, $500,000-$600,000 profit per year. They pay themselves maybe $120,000 to minimise tax in their own name. And they've got all these retained earnings that have been taxed, 25% tax rate, but it's given them a substantial amount of capital in a company doing nothing. There is no Division 7A loan. Now, for anyone out there, Division 7A loans is when you draw money out of your company, you don't declare it as a wage or a dividend. You've got to pay this nasty amount of interest back to your company and pay the loan off within 7 years. Not deductible to you, but assessable in the company. So it's a nasty thing. You're paying tax for no reason. But company to company don't have any Division 7A agreement. So you can literally lend the money from your active accounting firm or your landscaping business or your electrician company. You can literally put that money into company B and then use that money to go buy property or go buy assets.
Wow.
No interest, nothing. And you've already paid tax at 25% on that money. And what it does give you is more capital to go towards more assets. Now, as opposed to you having to draw that money out of your company as a dividend or a wage and paying higher amounts of tax either as a PYG withholding or what they call, accountants call this tax at the tail, called top-up tax, which is the difference of your marginal tax rate and the tax that the company is paid, which in most cases is 25%. So if your marginal tax rate's 47 because you've drawn out a lot of money to go put into an investment and your corporate tax rate 25%, you've effectively got a 22% top-up tax. Nasty. So that means you've got less capital now going towards investment. So you're a high income earner or a low income earner, whatever it may be, you've got a business making good profits, you don't want to take it out because you don't want to be slapped with all that top-up tax. You can move that money to Company B. Company B goes and invests in a property and you've got now more capital going towards more assets. A lot of accountants will advise, and I do the same, you don't want to be buying assets in your active entity. So if you're an electrician or accountant or landscape, whatever it may be, do not buy assets in that entity Because if something goes wrong, that asset will become obviously up for grabs, and there's a lot of implications involved. And again, the money you've lent out to your own company also becomes an asset as well. So you do need to factor in asset protection issues. But if you're not too worried about that and you've got the right insurances and you're a good operator, you might have more capital going towards more investments.
It's really interesting to hear, and I think these days, and Luke, I'm sure you'd agree with me. These days, I feel like every few years it cycles what like the most interesting thing is. I think given the accessibility and democratization of information around property investing over the last 5 to 6, we've seen that move a bit quicker. And we've seen a lot of things around SMSF and corporate trustees, trust and corporate trustees. But something I just wanted to ask. I don't know if the phrasing would be which is better, or probably it's maybe better asked as, is there a difference? In that circumstance, if you're a company, if you're a business owner, is there a difference between paying out as a dividend prior to paying the corporate tax rate on retained earnings versus leaving it, paying the 25% corporate tax rate and then paying the top-up tax at the personal level after? Is there a difference for people?
It's hard, and I haven't actually done the calculations in detail to determine what's better.
Yeah.
It all comes back to time versus value and money.
Yeah.
Right? So if I've got more retained earnings after tax at 25%, being lent to Company B then goes by as an asset, well, how quickly does that asset appreciate? How much did it appreciate by? Would I have been able to even buy that asset if I took the money out as a dividend? So it's a real challenging aspect to consider. But, in short, accountants or other property professionals will always argue to say that, you want to trade via a company, you want to invest via a trust, because a trust still will give you the opportunity of being able to flexibly distribute profits and still maintain a 50% discount. So, if I've got an asset which has gone growth exponential, millions of dollars of capital growth, going to be kicking myself at the end when I go to sell. Especially to get that money out of the company, I've got to then pay top-up tax, where a trust, with a 50% discount, worst case scenario, you'll be paying 23.5% on the gross gain. So I would argue to say a trust probably long-term would end up to be better, post all the tax being taken into consideration. But having that additional capital to buy a better asset now, with the company structure, company lending structure, might be beneficial. And look, I'm a big fan always of, if I'm paying lots of tax, I'm making lots of money. So I'll pay my fair share to make that level of return.
And I think that you're really hitting the nail on the head, right? Which is, I think, the spirit of this whole conversation, which is everyone's circumstances are unique, and it depends what you're doing. Because whilst long-term, as you said, the trust route may end up, which we're going to talk about very shortly, it may end up being financially better off if you make different decisions. Maybe the company is, if you invest for a shorter time, maybe that is a better. So I think it like you've said, and we always say, it really is about the personal circumstance, and you really have to understand the entry and exit plan as well as the overall strategic plan of where the entry and exit is factoring in.
Absolutely, and it goes back to that initial comment I said, the acquisition strategy.
Yeah.
What is that business plan behind it? And then again, accountant comes in and structures it accordingly.
Yeah, love it. All right, let's move on to the third of our 4. Let's talk about SMSFs. So, can you tell us a bit about it in general, and then also, pros and cons and considerations around it?
I am a big fan of super, always have been, whether it's industry or self-managed super. And as an accountant, I always urge people the tax considerations. Again, I said it before, an accountant is one of the rare people that can guarantee you a return. From a tax perspective, that is. But supers are brilliant. It's a great way to build up your wealth. I know we've talked about all these unrealised taxes. They're called a Division 296, that desensitised name for tax on capital gains that haven't occurred yet. But nevertheless, you get to $3 million. It's a good problem to have as a total superannuation balance.
I think a lot of people will be stoked with a $3 million super balance.
But super is brilliant. And again, I've seen in my nearly 20 years now of doing this, and probably when I first started in the industry, there was probably 100,000 super funds in the economy. And today, last time I read, was about 1.4 million people are operating their super via a self-managed super fund, a combination of buying property and other assets. You control it. You get a little bit of leverage with what they call the limited recourse borrowing structure or arrangement, utilising entities, custodians and bear trusts and trustees. It's a complicated entity, Not for us to really talk in detail today.
Definitely not.
The beauty of leverage gives you, if you do it well, with the right level of people behind you, a good cash-on-cash return. Yeah. Because 10% on 250,000 is not the same as 10% on a $600,000 asset.
Yeah.
So cash-on-cash return really does change when you add leverage into it. You can leverage into very unique products in super with shares.
Yeah.
There's only one provider I know that does it. For a majority of other people, unfortunately, shares will have to be purchased unencumbered. So you're really looking, again, at cash-on-cash returns on what you physically invested. But property alone, our firm, we manage a substantial amount of self-managed super funds. And the rewards and returns over the last 3-4 years, again, anyone who've invested post-COVID in that period of time has done very well, even in a high interest rate environment. They've done exceptional.
Yeah.
They've bought some really good assets. And now, again, there are restrictions with self-managed super funds, Luke and Lachlan, and that comes back to you can't borrow for construction.
Yeah.
So if you're looking at buying land and building, you can't do it. There are new build self-managed super fund compliant properties out there, but I just urge people to not get carried down the path of depreciation in super, and that's a strategy because the tax rate's 15% flat. So it's not really great from a negative gearing perspective.
Yeah.
And the beauty of super is it's a 10% capital gain if you hold the asset for longer than 12 months.
Yeah.
Because a super fund doesn't get a 50% discount, it gets a 1/3 discount. Accompany that with the 15% flat tax rate, and it gives you an overall effective rate of 10%. Now, my personal self-managed super fund strategy, I'm very transactive in my super. 10% tax rate. If I've had something that's grown, and again, we can't extract equity in super, so if it's grown by 400 grand, who cares?
Yeah.
It's a paper wealth.
Yeah.
I don't want paper wealth.
Not now anyway.
No, I want to see my money always invested and getting the sharpest level of return that I can. So I've been very transactive in my property journey within super, buying and selling and hitting 30%, 40% returns. Sell, move that money in now to deposits.
Yeah.
Get a good market growth, sell, move that money into 4 deposits.
Yeah, and that's really, really interesting. I guess for our listeners, like when you're taking that really active approach with your SMSF, like obviously if you are seeing that short-term spike in growth and you want to capitalize on it, you're not worried about paying the 10% capital gains tax. But obviously you've got other costs to consider as well, like your entry, exit costs and stuff like that. So I guess I'd love to hear your thought process around how you kind of rationalize making it economically viable to do stuff like that.
Always I'll factor in those exit costs as part of my overall return. But let's say for argument's sake, a lot of people in WA who have gone through 100% return over 4 years, annualized 25% per annum. That's beating, I'm going to arguably say 95 to 98% of all industry retail funds out there that are available to us as the normal everyday mum and dads. To me, if I'm then holding that property going through a period of stagnation and I've made 100% return on that property over 8 years, well, I'm not now 25% return, I'm 12.5% return. So that's something you need to factor, and that's why being an active, sophisticated investor in super is key. Because yes, my property has doubled, but it's now doubled over 8 years as opposed to 4. So if I'm seeing my property do very well in a short period of time, factored in for exit costs, I'm out. And I'll then move that money that's come from the sky that someone else has paid me because I bought well, I'll move that into now 2 properties. If I can replicate something very similar, I've now got a larger denominator invested in the market, and my property portfolio only has to move half as fast or half as strong to achieve the same results as my one property. So the goal is in super, and forget about cash flow. All these people talk about cash flow in super. Cash flow will come, and it comes at a certain time when you pivot for your retirement. But your goal is you can grow that denominator in super, and that's my goal anyways, grow it as hard and fast as I can. Then I'll find the right time to pivot when I need cash flow. Because generally speaking, and I'll go on this as a bit of a debate, having residential property within super at retirement's not ideal because its capital movement in most cases moves a lot faster than revenue. So when I come to pension phase and I've got to draw out a certain amount of money, you'll often find that residential property just won't live up to that amount that I need to withdraw, so it's going to force me to sell. Not a problem. But I want to have that golden goose that continues to lay eggs. And that's where you'll look at a cash flow strategy within super, heading closer towards retirement or at retirement. So, your goal is, guys, buy the best assets you can buy. Hold them for that period of time where you felt they've had their run. Don't be afraid to pull the trigger. And that's where I know, Lachlan, you guys do talk about exit strategies with clients. And moving that money into the next asset, moving that money into the next growth cycle in a different area. And that's where you can really start to be sophisticated with your strategy. Super is one of those ways to do it. I love it as an accountant, and the clients I've seen do it well, they've arguably had much better returns than any industry or retail fund.
How about for our listeners that understand your background, that you're a savvy investor, but aren't too, like, they're not wanting to take too much of an active approach to their property in super? Like, what are your thoughts process on taking a bit more of a passive approach, buying something now? Like, let's just say hypothetically, you're 57 years of age, you've got about 250,000 in your super, you want to leverage up into, $700,000 property. Looking at growth rates, you're probably looking at around like maybe doubling in value over the next 8 to 12 years, depending on performance and things like that. If that 700K property is worth, say, 1.4 by the time they're 67, now they've entered pension phase, right? Or potentially pension phase at that time period, unless they increase it. What kind of outcome? Like,
nothing wrong with it.
Yeah,
nothing wrong with it. I'd probably argue would say that your 700 grand or whatever it may be that they've got in super 250, 300 grand is not going to get to 1 million plus. Now, again, it's a very subjective comment that we've made, but I'd probably argue to say, based on my experience, they may not.
Yeah.
So there's no age that I would argue to say it's not right or wrong. It all comes back down to your strategy. You can be passive with your approach. You can be very active with your approach. But I think doing something is important, whether it's within super or you're inside your own name, doesn't matter. But doing something's important. You've got to have that strategy well worded. I think if you don't, that's when you do have mistakes. And don't gamble your super. It's not a lottery machine. Don't just go throwing things at penny stocks and the next crypto meme coin, whatever thing they want to do. You got to have very long-term, yes, sometimes long-term minded, but proven assets. Not something to test the water. It is your super. It is there for your retirement. Proven assets with proven returns, to me, is always first and foremost. Capital preservation, as they say.
And I really like what you said. And just before we go to the fourth and final one, I think, we see a lot of people in that circumstance, maybe not necessarily 57, but let's say you're at the back of 40 or the early stages of 50. They don't want to work forever, but they understand that, like, the horse hasn't bolted, but it started to move, and they need to make a decision very quickly if they're going to jump on the back of that horse or it is going to get up and it's going to gallop away. And I liked your example, Lukey, because, obviously it's not financial advice, but from what I see, and I think that you echo it from your comments, Jeremy, is if you were to just take that money and leave it in an industry fund, even if that industry fund moves 10% every year for the next 10 years, because it isn't leveraged, and you've obviously got to do it smart, it's got to be intelligent, it's got to be right for you. That 700K property that you could leverage into that's now worth 1.4, that you took out a 75 to 80% loan against, by the time you sell, account for the cost, account for the tax, you probably fundamentally changed your retirement journey by doing just that one property compared to what you would have had by just putting in your contributions over that same 10 years.
Absolutely.
And I think for a lot of people, at that point in time, they started to work around or very closely after super was created. And the education around super at that point in time was nowhere near as strong as it is now, because we've had 30 to 40 years worth of people who have gone through and started that super journey. So I think that's what I see for a lot of people that we talk to that are in that 50s or 60s. Education wasn't strong then. If you're a 20-year-old now or a 30-year-old now, not only are you going to have a full working life of super, but you've also had a full working life of education around super. And they're far more likely to have a different outcome compared to people who didn't have that.
I just want to say this, everyone that's listening, I'm going to give you a bit of a challenge. Tell me when, if you're putting comments together, tell me when's the last time you looked at your super balance. Arguably, you should be doing it once every fortnight because things move. And that's what, you've got to really treat super as a very important part of the asset journey. And you can do some very exceptional things with it. Again, comes back down to taking the action.
Yeah. And something that you also mentioned a little bit earlier before is like, and we see it from some people that come and speak with us. They're like, oh, you know, like I'm looking to buy something in my self-managed super fund, really want it to be kind of cash flow positive. They're focused on the cash flow side of things too much. What a lot of people don't realize is you're putting a minimum 20 to 30% deposit down already. And if there is any kind of deficit there, a lot of the time, if you're a PAYG worker, your contributions are going to meet that deficit.
Absolutely. Oh,
anyway,
you got to argue with people on that basis. I get in their face a little bit. I say, what's more important? You're going to make cash flow of $2-3 grand.
Oh.
I've had properties where I've built and sold and made $1 million profit. Now, if I kept them, the cash flow would be $3,500 a year. My great grandchildren probably wouldn't achieve $1 million of cash flow by the time that I built and sold it. So sometimes it's not always about the cash flow. In business, our concept, you spend money to make money. If someone told me this is going to cost you 50 grand to keep, but there's $500,000 at the end of the 10 years, and again, nothing's guaranteed, I'll spend $50,000 every day of the week. So again, every property has to have a business plan. What is your business plan? What's your exit strategy for that particular investment? And then it's just a matter of executing it the right way.
Yeah. No, I love it. All right. We've got one more to do. I am conscious of time. I know everyone loves listening to us drone on, but I don't know how much they love to listen to us drone on, right? So we got one more, and then Lukey, we're going to throw it over to you to put Jeremy in a bit of the hot seat under the lights for a few examples. But the last one, which I know is going to get a lot of attention, is around trusts and corporate trustees. There's obviously lots of pros, lots of cons, but lots of considerations, I think, probably more broadly. So can you talk to us about that type of structuring?
Yeah, trusts, discretionary trusts, or otherwise known as family trusts, most people call them, with a corporate trustee. So that means that the manager of the trust is a company, ideally non-trading. Very common now and spoken about quite a bit. I've done a lot of dialogue around it, but it's an important asset to a couple of things, get around banking policy. Good savvy broker will give you a bit of strategy around how to do it. Comes back to the acquisition plan of the actual entity itself. So working with the right people to find the right type of properties, and we'll talk about that a little bit more. But it's an entity which I would recommend for people after they've bought their first couple. Very rare circumstances why I say straight away, but after they've bought their first couple, because it's a very sophisticated entity. Good tax benefits attached to it, 50% discount on assets held longer than 12 months, able to discretionarily distribute to beneficiaries, which are family members, people itemised in the deed. So really good way of saving lots of tax. Great for high income earners. They can distribute to corporate beneficiaries, and that means they can fix the tax at 30% as opposed to distribute it to themselves at 47%. So some really good cash flow benefits there as well. But what most people are listening to this about or wanting to hear is, well, I've heard all these stories, I can get endless borrowing capacity. And look, to some extent, you can. If you play your cards right, you buy the right type of properties, you've got the right level of leverage in there, you're maybe a high income earner, you're very savvy with the amount of money that you've got. But that old rule of financing is 90% of the investment journey is true, because that's something that can keep you going and going and going. There will be a time where you just can't. And for a lot of people, they might be using equity to fund the deposit of a property in the trust and then borrowing the remaining 80%. That means you're 100% leveraged. Last time I checked, 100% leveraged properties are not going to be positive and will take some time to get there. And, you know, an accountant's not just going to give you any old letter to say it is. They still need to have professionalism and ethics. So it comes back to the property purchase. What's the acquisition strategy? Am I buying something that's got a good path to being positive? Granny flat. Is it a subdividable property that I can cut the back off, sell it, use the capital proceeds after tax to pay down the front? If you use the structure well and you buy the right type of properties that are conducive for the structure and what you're aiming to achieve long term, you will be able to continue your borrowing journey. Now, again, most people, and people go, well, why am I buying the first couple of my own name? Because the chances are you're very early on in your property journey, and it's something that property is not this beautiful one property per year linear journey. When there is a window of opportunity, Luke and Lachlan, and you've got, that window opens and you can buy 2, 3, 4 properties in a very short period of time, you do it. Then you go back to consolidating, saving a bit of money, building and ring fencing a certain amount of capital. Lending policies change. I've seen lending change many times, especially over the Royal Commission as well. When it's hot, you go hard. When it's not, you consolidate. Focus on capital, then you open up that next window when it comes. And a trust is a great opportunity that when that window opens, again, for a lot of people where interest rates may be coming down, they may be wanting to build their granny flat now, and it brings their property inside their trust with the corporate trustee positive. All of a sudden, with your broker, with the strategy that you've implemented, borrowing can come back and give you more opportunity to buy more property.
Yeah.
I love it. I love it. I mean, I think we could almost unpack that single point of structuring for an entire episode. But I think in the spirit of what this podcast is meant to be about, which is about taking people from start to finish, I think it's a really good definition even. I don't know if we call it a definition, but a really good description of it.
Yeah.
And I think that the key message that I would want people to take away from your explanation of the different structures is it's about your circumstances, but you need a plan. You can't be thinking about today only. You need to be thinking about tomorrow, the day after tomorrow, and probably the week after tomorrow as well, right? You need to have that planned out, because otherwise you're going to buy the wrong property, or the right property in the wrong structure, or the right property in the right structure at the wrong time. And there's all these other like the factors are endless that can go wrong. And that's why, and we did an episode on it. So if you haven't listened, go and have a listen to the episode about building your team out. Your team is so important, because you need, not only do you need to have the team members with their own expertise that is at a high level, but you need them to be able to work cooperatively together, because otherwise it'd be like having a plank of wood in the middle of a pool and 6 swimmers all around it, and they're all swimming in the wrong direction. The plank of wood's not going to move anywhere, right?
Absolutely.
And they could be they could be Olympic swimmers, the best of the best. It still ain't going to move. So you need the right advisors in the right team.
Absolutely.
Right?
Yeah.
So, Lukey,
mate, I have a bit that I want to unpack, because like
you've been busting. I can see it on your face.
I've been frothing for this part, because it's just something that's so topical. It's something that gets brought up so much with the people that we speak to, and like we've purchased properties for clients that it's their first investment property. We've gone straight into trust for them. Like and for other investors that we've worked with, they've gone straight into personal name. Something that you mentioned was like, for a lot of the time, like the first 2 properties might likely going to be suitable to go in personal name to begin with. But I just thought we'd actually run through a couple of different scenarios just for our listeners to kind of think about, and how it might be applicable to them. Obviously, this isn't financial advice, and you need to speak to your financial advisors or your accountants about what's going to be right for you. But like one scenario that I want to run through to begin with. So let's just say that we've got a couple. They earn around, say, $300,000 a year. They've got around, say, 1.5 million of borrowing, but they have ambitions to build out a scalable portfolio, right? So they don't really anticipate that their income is going to increase, any time over the next 5 years at a significant level. What do you think would be the best kind of setup, just at a high level, based on that kind of scenario?
Yeah, so state by state comes into consideration, but let's just say we've factored all that in already. If they've got 1.5 mil of borrowing and their plan is to spread that across 2 or 3 properties, I'd probably still argue to say the first 1 or 2 we do individually. We want to make sure we leave at least borrowing capacity for 1 more property, because we do need that borrowing capacity to buy in a trust. Because one of the main things I want to make sure it's clear, and again, a lot of people come to me saying, I want to do a trust, I want to borrow again. Well, send them back to the broker. Our broker says, look, you haven't got any capacity anyways. You just need to leave enough borrowing capacity for the type of asset that you want to buy in a trust. Don't just use it all and then think it's going to magically appear again, because then your strategy then becomes, well, how do I then get that property being positively geared, get that, that borrowing capacity back, and then I can go again. So don't not necessarily have to go from day dot, because you might want to lose a little bit of deposit, buy yourself a property. There'll be some negative gearing benefits you obtain. Again, not the reason why we invest, but we'll take it. And then, maybe hold some of that capital towards a property that can go into the trust, and then work towards bringing it to a positive position.
Yeah. And you mentioned kind of leaving a little bit of borrowing capacity left over, so you haven't completely exhausted your serviceability.
And when I say little, though, it's not 10 grand. It's enough to buy a property.
Yes.
Leave at least minimum 1 property's capacity to get something in a structure, if that's the path of wanting to build a bigger portfolio.
Now, just on that, is it worthwhile for somebody to think about, well, look, I've left about $500,000 of borrowing capacity or $600,000 of borrowing capacity. I'm anticipating that the properties that I've got at the moment, they're still costing me money, but the cash flow is going to improve as time goes on. But I'm also aware that property prices are also going to increase over the next 5 years. And I'm not sure when I'm going to be in a position to have the deposit ready for that next property. So they kind of feel like they might not have enough borrowing capacity at that stage to be able to pull the trigger on a good quality asset. Mm-hmm. Does that kind of make sense? Like, does it make sense to then, instead of kind of just leaving room for one property, should you be looking at structuring earlier so you've got sufficient borrowing?
Yeah, we're on your person's scenario, potentially, yes. Potentially, because you just want to make sure you're leaving that bit of gap there. But for most people, again, they've got this misconception that what they can borrow today is what they can borrow for the rest of their life. Yeah. It's not necessarily the case. True. Things will change, going to business, kids, holidays, health, sickness, all the other things that come with it. But I always still try to, where I can, try to save the client as much money as you can. Try to keep it simple, then start to really sophisticate the way we structure our properties at the right time. But for, again, trying to draw a general rule of thumb, you want to leave at least a property's, how's the best way to say it? You want to leave at least enough borrowing capacity to buy a property in a structure. Because once you close the door, it could be a very long time till it opens again.
All right. I've got a couple of other quick fire scenarios. So this is actually one. It's a guy I spoke to a couple of weeks ago. He's not a client. We just had a chat. FIFO worker, earns over $300,000. He's got a couple of investment properties and they've both been new builds. And he went down the new build route because
you can just imagine the FIFO bloke, can't you?
All the FIFOs do it. There must be some meta formula because all the FIFOs talk about is brand new builds for depreciation.
Yeah.
Most of them they overpay and they get lots of tax back. It's cost them an arm and a leg and they've overpaid substantially. I've always wanted to know there must be some meta formula.
They are getting targeted by the new build companies.
Could imagine.
But you think about it, it's easy, right? Like speaking generally, usually if you're a FIFO, you're going to be trade educated, right? Which means you might not necessarily have the financial literacy of other professionals. You earn huge money relative to the fact that you are trade qualified and typically income is related to your qualifications, right? And then what is it that everyone wants to save on? But if you also have a bit of a gap in financial literacy, you might not understand the trade-off, is tax. Everyone always...
They're just dangling that carrot of like, reduce your tax.
Exactly right.
Yeah.
And some of our best and smartest clients are FIFO /tradie setup. So it's not about trying to slant that at all. I think it's just about the generalization of standard of education or type of education that you've had at a certain point, and they get smashed for it.
And bombarded with very sleek advertising.
And you think, if you're a FIFO, you're away for 7 to 10 days typically, you're going to work hard that time, but when you're sitting in the lunch hall, what else you got to talk about except like how you plan to spend your money, because most of them are only there to make the money, this and that. I can, you can see it's, military is very, very much the same. I remember being deployed on ships, and you got the young seaman bosun who's talking about the Raptor that he just bought for $100,000 on his like $60,000-$70,000 salary, and then you've got the old fella who's saying, "Mate, you got to get into property," and then the young seaman bosun regrets it very, very quickly.
Absolutely.
Anyway, mate, we digress. We
do digress.
Yes. So. Anyway, going back to this guy. So he had two investment properties, new builds. He's been indoctrinated with the whole, buy brand new, claim the depreciation benefits, tax deductions, all that kind of stuff. Now he's at the position now where he wants to look at the next property, but he also wants to continue to scale, right? And going against the tax strategy saving that has been kind of instilled in his mind might actually cause him to make the wrong move. So since you can't claim negative gearing against your taxable income when buying in a trust, with only around $700K of borrowing capacity remaining, what kind of setup is best for this type of investor?
He's bought his first couple in his own name, so that's good. Definitely this is a clear candidate for a trust structure. He gets his borrowing capacity, gets his property in the trust, earns really good income. He can put enough of his savings, because again, I'm assuming he's renting as a FIFO worker, most FIFO workers do. He can put enough of his income, high income earner, going towards the property in the trust, get it into a position where it's neutrally and positively geared, gets his $700,000 borrowing capacity back, bit of growth, high income, more savings that he has. all of a sudden now he moves on to his fourth property. So he's a very clear candidate without sitting on the fence to go into structure. And if he does and plays his cards right, there's more properties to come thereafter.
Now, let's say he goes ahead and buys another brand new property, right, in his personal name, gets the tax benefits of that, right?
For anyone who can't see the video, Jeremy's face is just like contorting at the...
What is the approach for this guy to scale from here? If he's also kind of not anticipating that his income's going to climb much higher than where it's at the moment.
And typically FIFO workers go backwards because FIFO workers don't stay FIFO forever. So no, he's a very clear person that needs to think about what his income looks like 5 years from now.
Yeah.
And if he's buying at the peak of his income, where again, a lot of people, we grow into our peaks as we start to get a little bit later on in life. Yep. FIFO workers peak straight away.
Yeah.
And then as soon as they leave the FIFO position, they're back to, more civilian-based type of incomes. In wherever it may be, and it becomes really tough to then grow further. If he's got a unique opportunity where he can then buy in a trust, use that FIFO income to pay down a little bit of the debt, bring it to positively geared, he's now secured potentially more property in the future.
And I think, to me, that just, put, nail on the head of why the portfolio acquisition plan is so important, because if he doesn't do it right and he does exactly like you said, he now hasn't thought ahead. He hasn't thought his steps in front. And now he's capped himself for potentially the next decade.
Yep. And he's getting lots of depreciation on may not have a very high income.
Yes.
So
yes.
The irony.
But let's just say that now he's bought the brand new property, he's capped out. Now he's thinking, well, like I've got equity in my property, but I can't utilize it. I can't tap into it because I've got no serviceability left over. What are some steps that they can possibly do? Because you can look to transfer from personal name into trust, but there's a couple of things that you need to be careful of.
Yeah, capital gain tax and stamp duty. So it's a very big cost, and I often steer people away from it because the payback period becomes so high. No one likes giving stamp duty, Office of State Revenue and the ATO money in advance.
Channel a bit of Kerry Packer there. They're not good enough with what they get.
When we haven't, exactly right. We haven't received the funds. We're just giving it away very early. So no, I'm not a big fan of doing that. Yep. There are very rare circumstances when I have done it, more value uplift development scenarios of why we do it. But in that particular case, once you've done something, it's so costly to fix it.
Yeah.
You just, in his particular situation, and if you're listening, you are that person that had a chat with Luke, you definitely should be looking at structure and doing that now so you get yourself more properties long-term in the future.
Would you say in that circumstance, like let's say he had his two, he obviously didn't go with us, he's gone and bought some new build, he didn't do it in structure, he's now capped, not much really on the horizon. Would you say, I'm not saying it's today it needs to be done, but that's where he's now really starting to think about over the next couple of years, a strategic sell to unlock that borrowing gap.
And many of my clients do.
Yeah.
Many of my clients that, as they really start to sell down the properties they've had for quite a while, using that capital after tax, and then they're putting that and deploying that into more sophisticated structures because they're more sophisticated investors.
Yeah.
Not necessarily when you tap out, you're tapped out forever. You do have the opportunity to sell. You just got to make sure you stage it right and exit the property at the right time.
All right, Lukey, I know I can see your sheet of paper. I reckon if I took a punt, I reckon you got another 5 on there. But for the sake of all of our listeners' ears, I reckon I might have to call stumps pretty quickly on this episode. But Jeremy, mate, thank you so much for coming in. Your knowledge is absolutely fantastic. I think that for people to be able to listen to this on Spotify or YouTube or whatever, if they were to sit down and have a conversation like this, you'd be well within your rights to charge a significant amount of money for that type of insight. But thank you for the support of me and Atlas. Thank you for coming on to have a chat with us today. I know Lukey and I took a lot away from it, which I don't know if you want to say anything, Lukey, either, but I think it was just fantastic.
No, it was fantastic to have him on, and very insightful, very knowledgeable, and we appreciate you taking the time out.
Very honoured to be spending the time with you, gentlemen. I'm looking forward to more Pathway to Property, And really excited to see what you guys do as you start to progress through this brilliant podcast. Well done.
Amazing. Well, thanks for listening in, everybody. If you are looking for help to either start, build, or scale your property portfolio, come and have a chat with myself, Luke, and the rest of the team at Atlas Property Group. You can find us at our website, atlaspropertygroup.com.au. Drop your details in for a call, and one of the team will be in touch. But until next time, thanks for tuning in.
Thanks for listening, guys.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.